We are joined today by Mark Payton, CEO of Mercia Asset Management, the regionally focused specialist asset manager with £940 million of assets under management. Mark, many congratulations on a record FY21 with year-on-year NAV per share growth of 24%. What were the main financial highlights for you?
Yeah, and I think a theme that will come through our results is there are a number of metrics of positivity coming out of this, and if you like, we're on the start of a journey rather than the finish of one. So these are great results, but we think lead into better results to come. And in terms of what are the main financial results, again, there are a multitude of answers to that. Of course, assets under management have grown from 800 million to 940 million, which is a combination of funds under management as well as the balance sheet performance. You've got adjusted operating profit of 3.3 million. You've got additional to that are performance fees. And I think performance fees are worth dwelling on because that shows that funds are delivering. And these are many funds. So the Northern VCTs that we manage, our EIS funds that we manage, as well as our private equity funds. So a broad church of funds that are contributing to performance fees. And then, of course, NAV per share at 40 pence. So again, that continues to grow. And I think that's a very important metric that shows the value within the group and our direct investments.
Fantastic. And you mentioned you're at the start of a process, but FY21 appears to be the year that Mercia's business model as a specialist asset manager really matured. Having largely achieved the goals of your 3-year strategic plan a year early, AUM of £1 billion, evergreen balance sheet, sustainable profitability, you have set a new 3-year plan called Mercia 2020. What are the group's new goals, and how did you sort of decide these were the right goals for the next 3 years?
I think when talking about strategic goals and objectives for the business, it's worth just stepping back and putting context on the business and business model. The business model being, I think, somewhat unique in terms of the combination of third-party funds under management, as well as our own proprietary capital, and where the proprietary capital has a number of sort of objectives itself. So obviously scaling businesses alongside our funds into businesses within the funds under management, as well as selectively acting as a LP, a limited partner in a number of those funds as we look to move into new areas or scale areas that we are performing well in. So I think that's an important context that then led to our initial strategic objectives, which were very ambitious, that we set 2 years ago. They were 3-year targets of growing, as you quite rightly said, assets under management from £500 million to £1 billion, evergreening the balance sheet. What that means is generating more cash from our proprietary capital performance than we are investing, and of course taking it to a sustainable, profitable position. And we've achieved those ahead of schedule, 940 million, all but at that billion. Other than that, all achieved. And so we, as a board and as a management team, sat down to think of, well, how can we be more ambitious going forwards? And look to the next 3 years, a year ahead of schedule. And that's where the 2020 vision, if you like, came out, where we see a pre-tax profit on average over a 3-year period. And I think that's important because what we have is a strong performance from the funds under management, and then we have almost super profits coming from our direct investment. So on average, this 20 million pre-tax profit per annum. And of course, then growing assets under management, again, on average by 20% per annum over that 3-year period. And that's really where now our resources and energy are focused on delivering against what we call that 2020 vision.
And let's sort of turn to the investment portfolio. Mercia now has 23 investments with 4 exits during the year and 2 new investments. Given the strong growth experienced in FY21, particularly in the second half, can we expect this momentum to continue in FY22?
So momentum is a combination of scale and frankly delivery against a model that you believe in. And the model, as we just talked about, which is the hybrid model of managed funds and proprietary capital, is important to sort of just dwell on. So one always separates those two things out. And actually what's interesting, if you look at the performance of the funds, that's usually a sort of nice predictor of how is the balance sheet going to be performed. So a year ago, so the year before this financial year, we had, I think, 5 exits across the group. This year, 10. Okay, so that momentum and scale is building up because we've got over 400 companies now across the group's activities as we build ourselves. So do we expect that sort of activity across the group to continue? We absolutely do. And there are a number of things going in progress and process across the group. So activity continues, exits continue. They are exemplary exits in terms of that's happened on the balance sheet, but also more broadly across the group as well. And we are optimistic that that will continue.
Oh, fantastic. And in terms of the sectors, diagnostics, biotech and software sectors put in a very strong performance in FY21, whilst certain businesses in deep tech and clean tech, including the automotive sector, were negatively impacted by COVID-19. Will this have an impact on the balance of new of new investments in FY22?
So with all sorts of equity investments, be it private equity or venture, there is a holding your nerve piece amongst this. So it's not we're not short. We're not investing and expecting to get out several months later. We are investing through cycles, and those cycles are economic as well as sectoral. So things come and go out of fashion, and you just need to be investing through those and adding value so that you can take your return and reward when it comes at a later point in the cycle. As you quite rightly said, automotive took quite a hit during COVID. A lot of the manufacturing did. Hospitality, as we all know, took a hit. So there are sectors that took a hit. Now, within those sectors, you can see them coming back out. So there's been lots of news flow about factories, about gigafactories for battery technology, etc., coming through as the automotive sort of repivots to come back out from a growth cycle. And what's quite interesting, you look at our automotive businesses that we've got associated with, like Warwick, acoustics, like Impression Tech, just to name two, Faradian, the battery developer, those are really poised for growth going forwards. And we expect growth to come out of that sector going forwards in the coming years. Software's performed well. But what you have now is that is really quite a crowded space in many respects in terms of businesses, in terms of new opportunities coming through. But actually what's come through the back of that is if you look at gaming, where you've had a captive audience almost for a year, actually there's some gaming plays coming through that are really interesting now and really building momentum through that. So I think that we will continue to have a broad church approach in terms of sectors we invest in terms of stages we invest in, because we passionately believe in investing through the cycle. And to back that up is free cash. So if you have that long-term vision and you have that ambition of investing through cycles, you need the liquidity to do that. And across the group, all the funds that we have under management, our proprietary capital as well, we have strong liquidity, which means that we can take that luxury of taking longer-term opinions as we go through and continue to grow ourselves.
Fantastic. And yeah, that's one thing I hadn't mentioned was the amount of cash available to the business is in excess of £50 million now, which obviously places you very well for future investment. But Mercia is now a profitable business and supports a progressive dividend policy. In your results, there are a couple of references implying future M&A activity. What else can investors expect in FY22?
Yeah, and just bringing back to that observation about the balance sheet having over 50 million of unrestricted cash, and that's really important as well. That's cash to be put forward to making new deals, to expanding existing portfolio, and actually looking at how we grow ourselves. But in addition to that, we have over 200 million of free cash across our funds under management as well. So that's £250 million of firepower to put to work in the coming period. So I think that's quite impressive. What to expect from Mercia is more of the same, frankly. We've done a lot of new deals. So it's not just been supporting existing portfolio across the group over this period. We've done a lot of new deals, and those deals will need support as they look to grow, whether they're growing themselves or they're growing through consolidation within the sectors they occupy. We can fund that ambition. So expect to see more new deals, expect to see quite an ambitious approach to our existing portfolio. And just to remind you, we have a lot of internal resources, so we can put those internal resources to work for our portfolio. It's pretty unique for us. We can do things, we have a portfolio resource, so we can search for C-suites, search for NEDs, etc., for our existing portfolio and drive those through. We have our own internal legal team. We support the growth of those businesses as well. So that's that has come with the scale of Mercia. As we go on that tipping point, is those internal resources, that capital, the expertise. We have a great team here at Mercia across all parts of the group. Expect that now to drive performance. So what do you expect for this next year? I think more of the same, more investments, more performance, and more activity as we look to dominate, frankly, the domestic, the UK market as a provider of debt, venture, and private equity.
Fantastic. Mark Payton, CEO of Mercia Asset Management. Thank you for your time today.
Thank you.